have you with us, Grant. So obviously that's the setup for the sector right now. How do you feel about investing in banks at this stage of the game?
I think this is an interesting time. I mean, for a lot of Canadian investors is related to the banks because, I mean, for a lot of people's investment careers, if you will, you could set it and forget it with the Canadian banks. And I would just argue that I don't think that wasn't the case necessarily before, but it's really not the case now either. I don't think this is, you should treat this like 2020 where we can just buy the dip and look for opportunities on banks. I truly think that coming out of the next couple of years, we're going to see a clear difference between who's coming out stronger and who's not coming out as strong. And of course, that is perpetuated by the tariff and trade war situation that's going on. And so I'm cautiously optimistic, let's put it that way, John, on Canadian banks. I think you want to be a little bit choosy right now, and I wouldn't just buy the basket of banks and call it a day.
Just out of curiosity, would there be some names that you would lean more towards as opposed to leaning away from?
Yeah, I mean, it's one of those things where we're looking at the headwinds, and I know your guest just on now was identifying some of those headwinds, and that's the thing. I mean, when we're looking at the banks, if we're looking at a risk-reward perspective on this, just some of the banks are facing more of those headwinds coming at them, and the banks that have more exposure to other places in the world, whether it's in particular the United States, where we're still seeing further economic strength than we're seeing in Canada. I mean, Canada hasn't been a competitive place economically in quite some time now, and we were a little concerned about that prior to the tariffs and trade war talks, and now we're really concerned about it. And so the names I'd be leaning towards, I mean, if you want to play it a little bit safer, I still really like Royal. They obviously have that strong capital markets exposure in the U.S. I think that's going to play out well for them. So if you're playing a little bit safer, Royal looks strong. But BMO, I think, is a bit of a darling here. I mean, we started buying into BMO last year. And adding to the position. We liked it again pre-trade war talks. Now we really like it in this situation. The reports came in really strong, so we like that as well. So those would be the two I'd be leaning towards, and I'd be leaning away from the banks that are a little bit more geocentrically reliant on Canada. And National reporting today, I thought they had a decent report actually, but obviously, we see those headwinds facing a company like that. They continue to chug along. I'm not worried about the viability of any of these companies. I just think there's better opportunities in a few of them versus the rest.
Okay, so bottom line, you see a little bit more opportunity in a BMO or a Royal Bank versus others in the group. To your point about U.S. performance, like we had Scott Thompson, the CEO of Scotia, on earlier today, and they made that move to acquire close to 50% of a Cleveland-based bank, KeyCorp, and he was just talking about the year-over-year performance in the U.S., which kind of speaks to what you're highlighting, that there's that growth opportunity south of the border. But he did also talk about the longer-term opportunity for Canada in the midst of this mess. Like if all of this angst prompts us to find a way to create more productivity in the country, unlock more of our natural resource potential, maybe that is something that could help the Canadian banks longer term, both indirectly and directly. Well, what's your view on that?
Yeah, I mean, I would completely agree with that. I think Canada's at a great opportunity point right now where if we make the right decisions, we can do very, very well. And I actually look back to, the time when Jean Chrétien took over as the prime minister in that period of time. I think we could be entering in a period that's very similar to that where, we get strong economic growth and we maybe even balance budgets and things like that, and maybe even see surpluses at some point. I think we have an opportunity to do that here in Canada. But there's a lot of shoulda, coulda, wouldas in that statement, and so when it comes to investing money today, I think that I'd still like to remove the immediate headwinds that some of the Canadian banks are facing still, and because there are these economic challenges. Can we get through them? Yeah, I believe we will. I'm optimistic about that. But at the same time, I don't need to take that risk with my money when I still have great options like Royal and BMO, because they're going to participate on that upside as well. And meanwhile, in the meantime, they're going to have less headwinds facing them.
All right. Graham, before I let you go, what's interesting, I know the banks have to navigate all those issues, but then there's this broader conversation in a market where big tech had a big run, has started to look a little bit wobbly. We'll see what happens with, the AI darling NVIDIA. But a case has been made now for looking at opportunity beyond U.S. borders. And I just wonder how you're thinking about portfolio strategy, what kind of questions you've been getting more broadly speaking from clients recently.
Yeah, I mean, listen, I think that the one thing that we have the benefit of today, it's easier than ever, is to have a globally diversified portfolio. And I think that investors should be looking well beyond Canadian borders to make up their portfolios and beyond the United States as well. I mean, if you had to choose one market, I would probably choose the US just because it's so broadly based. But there is so much growth opportunity out there. And I think good companies, even if they're domiciled in the US or Canada for that matter, are looking at diversifying their revenue streams. And so we're looking at even in the tech space, companies that are beyond like the Magnificent Seven and especially beyond the NVIDIAs. Because I mean, everybody knows those are great companies. It's really hard to make good growth in those. But I do think that there's a lot of good investment opportunity if you're willing to step outside of the well-known companies and take a position there. I mean, Block is a company that we still really like. It had a rough report recently, and they created, in our opinion, a better buying opportunity. I think it dropped 17% after the quarterly earnings came out, and we've been buying it for years. Obviously didn't like the report, but we think that's short-term headwinds that they're going to continue to do very well, and especially as consumer spending picks up in time. So yeah, I think to your point, John, there's lots of opportunities out there. I'm optimistic over the next couple of years, but we're also prepared for volatility, and I think that we're going to continue to see that. But that's not necessarily a bad thing for a growth investor.
Okay, and there's a look at Block shares. That's Jack Dorsey's company, XYZ or XYZ, I guess, depending on which side of the border you're
Canada,
talking about. Hey, Grant, thanks very much. Appreciate it. Grant White joining us from IA Private.